Hello and a very warm welcome to today's webinar, Scope's 2025 Banking Outlook. My name is Keith Mullin and it's my pleasure to be your moderator for today's session. I'm delighted to be joined today by three of Scope's bank credit analysts. So let me introduce you straight away to Pauline Lambert, Carola Saldias, and Alessandro Boratti. Hi guys, great to see you all and thanks for being here today. Now, with so many factors and themes at play in Europe and globally, across politics and geopolitics, monetary and macro, it's certainly a fascinating time for European banks. But those factors do throw up a number of challenges. A key question we're going to address today is, are the banks in shape to deal with them while also remaining profitable and protecting asset quality? We'll also address some topical banking themes, including consolidation and others. Now, in a moment, Alessandro and Pauline will deliver a short presentation. After that, they and Carola will be delighted to take your questions. So please do type these into the questions function and we'll get to them after the presentation. At the end of the session, we'll be delighted to give you advanced sight of Scope's 2025 Banking Outlook Research Report, which is a comprehensive document covering everything we'll be discussing today and a lot more, and it's brimming with insightful charts and narrative. I'll explain how to download that at the end. So that's it from me. Let's get started. Alessandro, I believe you're going to kick us off, so I will hand over to you.
Thank you, Keith, and good afternoon to everyone. So before starting, I would like actually to give a very short presentation of who we are and also frame what we have done for this outlook. So we are a team of 12 people sitting in the major European hubs, and we cover a portfolio of 120 credits from 75 independent groups. 48 ratings are publicly available on our website, so if interested, you can check them online. The outlook is the result of a recurrent exercise that we run here at Scope's Financial Institutions as part of our monitoring exercise. We have carried out forecasts on a sample of the 40 largest banks, and we'll see in a moment what we have prepared for you. Most of our ratings carry a stable outlook. Despite the uncertainties, we see downside risks and upside risk currently balancing out. And the positive and negative outlooks that you can see as of December 2024 represent rather issue-specific factors rather than sector-specific ones. So we don't have directional outlooks specific to countries, and I thought this was very important to highlight it before going on, before continuing with my presentation. Last point that I want to say is that we haven't the improvement in profitability that we've seen so far hasn't translated in several upgrades and positive outlook. And the reason for that is through the lenses of our methodology, we look at structural improvements. We look at through the cycle levels of earnings rather than cyclical ones. So if the current state of earnings will be maintained, the profitability will be maintained over time, then there could be upgrades on our rating coverage. Now, there are a few messages that I would like to pass on to you today, starting from profitability. Margins first. Margins have started to decline in 2024. Our early estimates show that there's been a decline by around 20 basis points compared to the peak in 2023. But the key message today is that we see, yes, further decline in margins, but margins both in 2025 and in 2026 will settle at a much higher level compared to the pre-pandemic era. And there are two main reasons for that. The first one is that we see we see central banks cutting rates moderately, and the end state rate levels will be much higher compared to the pre-pandemic era. For instance, for DCB, our colleagues in the sovereign team sees the key rate being at 2.25% at year-end 2025 and 2% at year-end 2026. So we are at about 250 basis points higher than the pre-COVID era. The second element that is important for margins is the fact that banks have well prepared for this scenario, and we have estimated that they've halved their revenue sensitivity to the changing rates from the year-end 2021 to June 2024. They've done that mainly through structural hedges. And this, of course, plays a role in the trajectory of margins going forward. The second important message that I would like to give you is that we see revenues stagnating in the next 2 years. But there is something important to keep in mind is that this is not a negative from a credit standpoint. So we have had a very important improvement in revenue generation over the past 3 years, mostly on the back of higher rates. And we see the banks more or less maintaining this level over the next 2 years. And I've just said that margins are declining, so there is a negative impact on net interest income. But on the other side, there are two things happening that will counterbalance this effect. The first one is the expansion of loan volumes. You can see in the chart on the left-hand side. This is the forecast, bank's own forecast for 2025 and 2026. And on average, at European Union level, they see, I should say, loan growing at around 2 to 3% in 2025 and 2026. There are cases where loan growth will be milder, like in Italy, but overall, this will be a positive effect on net interest income. The second element supporting revenue generation is the expansion in non-interest income. For instance, wealth management revenues, insurance revenues, and so forth. And this is an important source of income for lots of banks in our coverage, and we see this as supportive for bank revenues going forward. Third and fourth points on profitability. One is on costs, one on cost of risk. So on costs, we see the cost base growing in the next 2 years, and the result is that cost to income will worsen from the current levels. Actually, this has already started in 2024, and we see, let's say, a normalization in the cost to income towards the 60%. Of course, I'm talking always on the 40 banks under our study here. The reason for that is there are still attrition in some areas in Europe, like in the Nordics, or for banks that have operations in emerging markets, where there is upside pressure on salaries. And this is an argumentation that applies to all banks. Banks are investing lots of resources in digitalization, automation, artificial intelligence, cybersecurity, and this is more and more needed for all the banks. And although there are also, of course, cost savings from these kind of investments, but in the short term, we see, let's say, more upside pressure on costs rather than downside. And so the outcome will be a worsening of the cost-to-income ratio. Then on the right, we have proposed this chart that shows the buffer in 2025 between pre-provision profits as a percentage of loans and cost of risk. And you can see that for all the 40 banks in our sample, the buffer is quite comfortable. The key assumption here is that cost of risk will only marginally increase. And the reason for that is that we see the economic growth being supportive for asset quality, tight employment, lower debt service costs as interest rates decline. And all these factors will, of course, support asset quality and in turn, cost of risk. We cannot also forget that banks have accumulated impairments over the past few years that haven't been used, or it should say reserves that haven't been used, and this can be tapped if needed, and they can absorb extra provisions if or spike in defaults if needed. These slides summarizes the key points that I've laid out to you. So on the left, you can see the base case scenario where we have ROE declining from the heights of 2023. We see already a decline in 2024 and a further decrease in 2025 and 2026. And this is mainly driven by the worsening of the cost-income ratio, as well as the small increase in cost of risk. On the right-hand side, you can see our worst case scenario. We've basically played around with numbers. We have imagined a scenario where there is a recession, so negative economic growth, and an impact on revenues and on the cost of risk. Let's say a scenario of recession where you have the central bank cutting margins by 20 basis points more than the base case in 2025, and by 40 basis points more in 2026. And cost of risk would be 50 basis points higher across the whole coverage in both 2025 and 2026. Even under this stressed scenario, we would have ROE positive both in 2025 and 2026, but of course some banks would report losses, but of course this is a stress scenario only. Now on asset quality, I would like to complement what I've just said of cost of risk, adding that we don't expect major deterioration in NPLs. In fact, we see more convergence going forward among different countries. As you can see on the left-hand side of the slide, there's been an ongoing convergence in sectors' NPL ratios, and with this, we see this continuing over the coming years. Perhaps something to highlight here is that as we have laid out in our report that has been published, I think, on Friday on asset quality, we see some attrition in the corporate sector in some countries, but aside from that, the overall picture is very supportive for banks' asset quality. A word on capital as well. So in the past 2 years, we have seen a stabilization in the minimum buffer over capital requirements. We are talking about 4%. And this is the result of different factors at play. So on one side, you had a very strong organic capital generation, and the banks optimizing their capital allocation when possible. And on the other side, you had shareholder distribution throughout either cash dividends or share buybacks. Now we see this trend actually continuing in the next 2 years. Now, what could change is that, first of all, we see lower profitability, so lower capacity to generate organic capital. And the second point is that the drivers of profitability will change. So you have lower margins, higher volumes, and so this is is basically the profitability that will convert into capital is lower for the same level of profitability, because we have a more volume effect rather than a margin effect. And I'd like to finish my part spending a couple of words also on funding and liquidity. Last year we were actually very, let's say, negative, or at least quite negative on the sector, because we had experienced a mini crisis in the US regional banks, Credit Suisse going down, and also deposit volumes declining across Europe. And we expected this trend to continue in 2024. We have been surprised actually on the upside. So positively, deposits have expanded in 2024, and attrition, especially in the Nordics, in the Netherlands, is declining, and this is very positive, of course. At the same time, in 2024, banks have managed to repay their TLTRO3 funds without too many hiccups. And although the liquidity coverage ratios have declined from the heights of the pandemic era, they are still well above requirements, and we don't see this changing going forward. So that concludes my part. I would like to hand it over to Pauline for further remarks.
Thank you, Alessandro. I would now like to discuss some sector developments that we see relevant for the European banks. Two of these, consolidation and regulation, we believe are generally supportive for the industry, while the other two, cyber risk and climate, actually are potential risks for the industry. So the first theme, consolidation. And this is one that we do expect to continue this year. And it makes sense given the fact that we are entering into a less supportive interest rate cycle. So banks will be interested in maintaining their current market valuations and to create value for shareholders. They will be looking for transactions that will bolster their competitive positions and boost revenues. Businesses that generate non-interest income and that are capital-light businesses are going to be particularly attractive. We also see capital as being a driver for further consolidation in the industry. So here we're not only talking about mergers between banks, but also consolidation in business lines. There are opportunities, for example, for banks who are using internal risk-based models to acquire banks using standardized models. As well, since January of this year, the Danish Compromise has been made permanent in CRR3. And this change really encourages the development of bank assurance and financial conglomerate business models. So as we look on this chart, we can see that some banks are natural consolidators due to the levels of excess capital that they hold, and as well due to the relatively high market valuations. So in terms of bank mergers, we do see greater potential for domestic transactions because there are greater synergies to be achieved in terms of physical distribution networks and overlapping central functions. In regards to large cross-border M&A activity, we believe that this is less likely. And there are, of course, fewer opportunities for cost synergies. There's also potential regulatory ring fencing, which limits the potential saves that can be realized in terms of funding costs. And the European Banking Union remains incomplete. So the fungibility of liquidity and capital across borders is not a given. As well, with large transactions, we also see that there can be political resistance, which is also an impediment to these transactions happening. Now, moving on to regulations, I would like to focus on the implementation of the final Basel III reforms. So as agreed by members of the Basel Committee, these were supposed to be implemented in January of 2023, with full implementation by 2028. So as we stand today, we can see that there is certainly a delay. But if we look across the various jurisdictions globally, the implementation of final Basel III reforms is increasing and continues to make progress. Now, in Europe, the time frame for implementation is broadly aligned. So as we know, since January, CRR3 has been in effect in the EU. Switzerland also implemented the final reforms in January, and the 3 additional member states that comprise the European Economic Area will also soon implement the final reforms. We have seen that the UK has postponed the implementation of the final reforms again until January of 2027. And this is from the earlier implementation date of January 2026. However, it is important to note that the UK has not moved the final implementation date, and it still stands at January 2030, which is still before the final implementation date in the EU, which is January 2033. It is also worth highlighting that the EU has actually decided to postpone one aspect of the reforms, and those are related to market risk standards. This has been postponed to January of 2026, and in doing so, the ECB noted at the time that they thought there were going to be delays in the other major jurisdictions, and they were also concerned about the competitive dynamics, that this could negatively impact the competitive position of EU banks. So given the recent developments in the UK and what is happening in the US, there is a possibility that this particular aspect of the reforms could be postponed again. Now, the situation in the US remains uncertain. The US proposal for implementing the final reforms was presented in 2023. And this proposal would have increased the CET1 requirements of large US banks by 16%, so a bigger increase than what we've seen in Europe. At the same time, it would have also increased the scope of banks that were under the scope of the rules. And also the implementation timeline was January of 2028, so several years earlier than in the EU. Now, last year in 2024, the head of US banking supervision highlighted in a speech that the US agencies were considering changes to the proposal. And these changes would have then reduced the capital requirement or the increase in capital requirements for large US banks to about 9%, so more in line with the increase in the EU. At this time, under the new Trump administration, we do believe that the drive to tighten regulations will certainly decrease. But at the same time, we don't expect that the US will move in such a direction that the largest US banks who compete internationally will no longer be subject to stricter supervision and tighter regulations than smaller US banks who are primarily domestic. So we think that sort of dynamic will continue in place. And clearly, we are still waiting for what the US will decide to do with the final Basel III reforms. But I think overall, our view is that regulators globally remain committed to implementing the final Basel reforms, and that they want to ensure that banks remain sound and they want to safeguard financial stability. So in this respect, we also expect regulators to increasingly focus on the potential risks to financial stability that can come from non-bank financial institutions. Now, moving on to cyber risk and data security, what we do see is that these are two drivers that continue to drive the operational risk for European banks, which has continued to increase. And while it is still very difficult to monitor these risks at individual bank level, we do have data that shows that these types of IT-related risk are increasing for the sector as a whole. So in the EBA's regular risk assessment questionnaires, which are performed every 6 months, banks are specifically asked, have there been any cyber attacks that have resulted in a major ICT-related incident or have the potential to have resulted in a major ICT incident over the past 6 months. And as we can see on the chart on the right, the number of incidents has been increasing. So this is driven by the fact that there is an increasing use of digitalization as well as rising geopolitical risk. The IMF data also shows that these risks are rising for the sector as a whole. Since the pandemic, the number of cyber attacks has doubled, and the number of extreme loss events, those of an impact of more than $2.5 billion, have also been increasing. The financial sector remains a key target for cyber attacks, and they account for about 20% of all cyber attacks. Given the increasing risk from this sector, we view positively the supervisory focus on these risks. Last year, the ECB performed a cyber resilience stress test, and they took the results of those tests into their supervisory practices for the following years. And they are continuing to work with banks on an individual basis to ensure that they manage these risks properly. Lastly, I would like to touch on the topic of climate-related risk. So my colleagues, my ESG colleagues, have actually performed a study where they looked at 72 European banks and the potential impact that could come from climate risk. They analyze how the credit portfolios of these banks would perform under the Network for Greening the Financial System's 3 scenarios. And what they found is that there are actually potential large credit losses that banks could face. In the disorderly as well as the hothouse scenarios, credit losses would more than triple. And what we see also is that if we looked at the pre-tax credit portfolio return on assets, this would drive these returns into the negative territory in the disorderly as well as the hothouse scenarios. And in this case, about 20 banks would actually move into the negative, we would have negative returns from their credit portfolios. The study also found that banks in both Southern and Eastern Europe are more vulnerable due to their exposure to physical transition risk, and that they could potentially face additional credit losses of more than 250 basis points annually due to these risks. So again, this is another area that supervisors are focused on, and it also reinforces our view that banks need to have credible climate risk management strategies in place, and that they need to proactively engage with their clients to manage the risk in this area. And so with this, I would like to conclude and hand it back to Keith for Q&A.
Great, thank you very much, Pauline and Alessandro, for those comments. So we do have some questions already, but for those viewers on the session, please do type questions if you have them. Carola, you've been very patient there, listening along with myself to the comments so far. So let me put the first question to you, if I may. So we finished the presentation talking about climate and cyber and data security risks. And just perhaps on a general point, I mean, the outlook that was presented by Alessandro was cautious, I guess. But I was just wondering, there's so many negative events swirling around the world and the sector. Are there any other risks that banks might face thematically that are out there that you think could be brought to bear at some point?
Thanks, Kit, for the question. I think that for sure, as Alessandro has mentioned before, we have a stable outlook and we're somehow conservative about the evolution for banks in 2025. But we cannot deny that downside risks come from let's say, a macro scenario in which interest rates move in a trajectory faster than expected, decreasing again in a faster way compared to our basis scenario, and that will also cause that banks will need to face say an adjustment on margins again quicker than expected, and reshape a little bit what will be also the repricing of the balance sheet, comparing that they have now a significantly larger component of time deposits, compared to what we have seen 2 years ago. So this is for sure a scenario that can add pressure to the profitability if let's say it happens faster than expected. Of course, as you mentioned, there are a lot of let's say issues happening at the level of government and political instability, if we can mention that, not only in Europe but also, let's say, across the globe. We have now a new government in the States with I will say a completely different strategy to compare to what we have seen in the past 4 years. And this will for sure shape a little bit the dynamics of the competition coming from larger banks in the States, and also at the end of the day, grow prospects for the global economy and the larger partners of the EU. So for sure, those are two elements that can say shape a little bit for the negative side profitability of banks if let's say our say not base case, but our, let's say, scenario of worsening of these two elements could become a reality.
Okay, great. Thank you very much. I'm just watching the questions come in here. There's quite a few. So we are going to just jump around a little bit around the thematics. So hope that's okay. Look, there's a question. I guess, Alessandro, I could pose to you. There's a question. You talked about asset quality in your comments, and you showed some the NPL ratios converging. But there's a question here about which is, what's the view on credit risk, especially in regard to the meaningful increase in NPL stocks for French and German banks over the last 2 years? Now, I'm not going to, I know you don't cover the French and German banks personally, so I won't ask you specific, but can you just perhaps reiterate your comments very briefly on asset quality and NPLs?
Sure. I've seen that there are many questions on credit quality, so it remains years after the aftermath of the global financial crisis. I see that it's still a very hot topic. So we have we expected the deterioration in asset quality in 2023, I think, and we have reiterated the same expectation also for 2024. And now we are at 2025, and actually not much has happened across our coverage. I cover Italian banks, and really, actually, what we have seen is the opposite. So we have seen the laggards in terms of NPL ratios improving, managing to reducing their exposures and catching up with the best in the market. And outside Italy, yes, there are some pockets of risks. Commercial real estate was quite kind of a on the quite hot sector last year, but it seems that things have also improved over there. Maybe Carola can add a word on that. I've said, and I'll reiterate it, that we see some convergence, which means indeed that while you have perhaps the Southern European peers catching up, you've seen perhaps the more core Europe, some worsening in the core Europe. So it's true that in Germany there has been some deterioration, and we, our sovereign colleagues, expect Germany to be the laggard in terms of economic growth. So there could be some attrition over there, but otherwise we remain pretty constructive on asset quality going forward across the whole coverage.
Yeah. Okay. Thanks, Carola. Let me come back to you. There was a question about French banks specifically. I don't know if you want to talk. Can you talk just briefly about French banks in the context of asset quality and I guess performance as well? Because they were the weaker performers last year. Can you just outline your outlook very
Sure.
briefly on French bank? And then while I've got you, could you also follow up with a brief comment on commercial real estate
Yes,
exposures?
sure. So probably on commercial real estate first, to follow up from what Alessandro just mentioned, I think that it was for sure, let's say, under the spotlight, the commercial real estate sector since, I would say, the beginning of the increase in interest rates. We have seen countries that have faced a significant exposure for the downside on the, let's say, deterioration of the commercial real estate sector because of the exposure of banking and investment managers towards real estate projects. And here, I think that we need to consider two elements about the risk that the commercial real estate sector still faces. One is the interest rate environment that for sure will remain higher as it was in the past decade, and that was a significant facilitator for the growth in the commercial real estate sector in general in Europe. And now the conditions have changed, and margins and the performance and profitability of those large players, it's of course changing, and they will need to reshape a little bit their funding structure and probably downsize their portfolios largely to face these different, say, funding conditions. And that, of course, places these commercial real estate developers or players in a situation in which they will need to rethink their strategy and focus on those projects that are really profitable and that they can keep going. And then this takes it to the second risk that is related to this sector, is about the reshaping on the commercial real estate industry, in which after the pandemic, we have seen a significant shift on the uses of offices and the use of commercial real estate that before was probably a given, that was occupancy was almost at full levels. And now we see that this is not the case any longer. We have the office working dynamics changing. We have also the dynamics of the use of commercial real estate spaces, with this big commercial spaces probably downsizing a little bit, and that also reshapes a little bit the way that the commercial real estate sector will grow going forward. So I will say that these are the two risks that are still in place, and this doesn't put now the spotlight about the interest rates, but about the business model and the feasibility of the commercial real estate players in the longer run. So I think that that's an element that we need to continue monitoring, and that has not materialized yet, evidently, on asset quality issues. So we have seen that across the different countries. Of course, in some countries it has been much more closely monitored and has translated into some asset quality issues, but not at the level of putting at risk the sector in a specific country. So for now, it is, of course, as I said before, a risk that we will continue monitoring, but has not translated into, let's say, several losses that we can consider as a stress scenario. Now moving into the French banks discussion, that probably has been a very interesting evolution that we have seen in 2024, because most of the European banking sector has been performing very well, with the profitability at let's say peaks, and with a performance has been, let's say, leaving behind the very, let's say, I will not say weak, but smooth performance that has been for the past decade. And French banks were somehow lagging about this very positive momentum that all European banks were facing because of the structural differences of the market. Let's say the repricing of the balance sheet, it's by structurally slower than what we see in other jurisdictions. They are also say considerations about the dynamics of the industry, that it's much more regulated in terms of the interest rates ranges. And that, of course, is now turning on the positive side for French bank, because they are now really being able to pass, let's say, the increases in interest rates under a slow trend, but that will bring the positive say upside now in 2025. It is also important to mention that for sure, when we see the French banking sector compared to other jurisdictions, we see a very large sector that has a physical network that is very, very important, and that weighs also in the operational efficiency and doesn't allow for the, let's say, French banks to compare, I would say, very positively in terms of efficiency and cost to income ratios and operational dynamics as we have seen in other countries. And this, of course, now it's also providing some, I would say, relief because of the increase in revenues that will allow a little bit to improve little by little the efficiency. So we should expect that the French banking sector should, for 2025, already show some positive signs compared to what we have seen in the past. For sure, it also depends, and going back probably to your first question about the downside risk related to a faster reduction in interest rates, and that will depend also how that happens and how that could affect also the repricing of French banks to remain in the upside within the ranges. And also related to the second point about the political instability, we have seen also the government in France being a little bit under the spotlight, a little bit, probably it's not the right word, but that has been facing some difficulties, and that also could place some confidence issues in the market for, let's say, the growth on lending and the, let's say, the growth potential that we can face for 2025. So I think that here we have, let's say, two sides of the coin in which there is still a lot of positive potential for French banks to perform comparably better to the European peers because of the lagging effect, but also the uncertainties related to what we mentioned before about the potential downside risk that we see in the banking sector in general.
Yeah, absolutely. Yeah, thanks for that. Pauline, there are a couple of questions on consolidation, but which I'll ask in a second. But there is one question. One questioner is asking to repeat these statistics that you laid out on the climate risk. And so the climate risk study is actually going to be available for download at the end of the session. And so rather than going back and repeating the stats again, which is based on the NGFS scenarios, you can download the presentation, the research document, and read through the methodology there and the outcomes. And there's also a question about whether we can release the underlying data for some of Alessandro's charts. And to that question, let me just check with perhaps internal compliance to make sure that there are no issues there in data disclosure. If it's not a problem, then we'll send it to you. So now, anyways, with that, I'm just ticking off some of the questions as we go along. So Pauline, there's some question. You talked about consolidation, and you talked about the fact that domestic consolidation in some respects is a lot easier for technical reasons and other reasons than cross-border consolidation. So I'll just read the question. It says, at the end of the day, is it easier to do a cross-border or domestic merger? And would that make the sector actually stronger? And another, I guess, a related question was a very similar question, which is how likely would you think a real cross-border consolidation could take place in Europe? So I guess similar sort of kind of questions, but perhaps can you just address that? Pauline, you're on mute, I think.
I guess there was a lag. Okay.
Yeah.
I think some of the live transactions that are happening, it's certainly raising a lot of questions about, how palatable are transactions, M&A activities between banks in different countries. And I think that, in terms of strengthening the banking system as a whole and in support of the fact that we would like a European banking union, these transactions would be positive. But, I think it still remains a bit difficult for politicians and governments to accept these transactions. So, I mean, I don't know if maybe Alessandro might have a view on this too, considering that he's covering the banks that are, sort of in the spotlight here.
Yes, I can jump. Well, first of all, what I would add is that we see lots of room for domestic consolidation in Europe, especially in Italy. And the reason for that is that in-house, or I would say domestic, within a single country, M&A activities still make sense. There are a lot of overlapping branches, lots of costs that can be cut, revenue, also synergies can be extracted. There can be also on funding, there can be synergies. For what concerns cross-border mergers, the rationale is a bit weaker, in our opinion, at least in a still fragmented banking union. Of course, there have been massive improvements and massive steps taken by European institutions towards that target of a truly European single market and a truly European banking union, but we are still not there. And so the synergies across borders are really not there. Maybe investment banking it could be for larger groups. And one thing that I would like to add, I know there is a question I've seen is on UniCredit. One thing that we have already pointed out in our commentary that we published, I think it was November, is that actually is not a real, wouldn't be a real cross-border transaction, because UniCredit already has a subsidiary in Germany. So there would be rather a merger or an acquisition from UniCredit, and UniCredit is already there. So yeah, I would say we are much more positive on domestic consolidation than cross borders for the time being.
Yeah. And Carola, is that the same in Spain? We've got a live situation in Spain as well. And so,
Yeah.
what's the reaction been to that? In terms, how do you see that evolving?
Yeah, I think that's a very interesting evolution that we have seen since last year. We have the hostile offer from BBVA to Sabadell that happened in May last year, and that is still ongoing. There are some, let's say, regulatory approvals that are still need to go ahead. And that is a purely, I would say, domestic rationale for the operation, in which the BBVA will increase significantly its operation in Spain. And in that context, that makes completely sense for the, let's say, for the efficiency and for the, let's say, the strategy of BBVA to strengthen its position in its home market. But I would like to also say what is happening today in the news with BPC and Natixis, that we see also significant operations, not just about mergers, but about acquisitions and joint ventures to really strengthen business models. And this is really, let's say, not only related to the banking portfolio, but to really, let's say, open financial groups to a revenue distribution that is not only coming from banking activities, but for wealth management, asset management, eventually also fintechs or any other specialized finance operation that adds value and that can be of a stable source of revenues to grow in the longer run. So here, this is not just about, let's say, cross-border acquisitions or mergers. It's about banks and financial institutions really looking towards a broader business model in which they can grow without eventually the significant cost of a banking portfolio that we know that has some limitations, but to really trying to push towards, let's say, the figure of financial conglomerates, if that makes sense, to compete on a broader scale with say, players outside of the EU. So I think that probably is the message that we see the intention, and we see the, let's say, the appetite of larger European players in 2024, and probably it's going to be also in 2025, to really move ahead to the, let's say, become much more competitive, not only in banking, but also in terms of other financial services.
Yes, indeed. Yes. Thank you. Pauline, there are a couple of questions about significant risk transfer, SRT. And of course, this has been a topic of growing. I mean, we've seen a lot more in the last couple of years, particularly. So generally speaking, do you have any particular views on this phenomenon? Do you have any concerns? And I guess there is one of the questions focuses or mentions the potential for European regulators to impose restrictions on banks' ability to execute SRTs over the medium term. Do you want to pick up on this theme?
Sure. Well, I think when it comes to risk transfers, this is quite an established tool that European banks, have been using for quite a long time. And it does make sense, as capital requirements are increasing, banks are looking at risk transfers to manage their credit risk and to optimize capital. So from our perspective, it's certainly, a tool in the toolkit that banks can use and would like to use. It makes sense. However, when we think about them, what we would look at is, we would like to understand how the transactions are structured. Are the risk going to be removed from balance sheets on a permanent basis? If not, will these risks need to be rolled over? And how does that work? How easy is that going to be? As in terms of the way the transactions are structured, are there potential risks to counterparties or to investors in the securities that are often related to these transactions? And also, how dependent is a bank on these types of risk transfers? Yeah. So these are the things that, that we would look for. It does give us some comfort that, this is regulated, that the supervisors and regulators are looking at these transactions, so they have an overview of what's happening. So, in terms of, I guess, how the regulator is going to act in the medium term, will they decide to limit these transactions? I think it will depend on how comfortable they are, with the fact that banks are doing these risk transfers and how dependent they are on them, to use these to manage their risk and to optimize capital. Because I think, at a certain level, it seems very reasonable, to, use a tool for banks to use in the end.
Yeah, absolutely. Okay, thanks. Conscious of our time here, but I wanted to get a couple of final questions in, if I could. And actually, I think I'm going to stay with you, Pauline, because you covered the climate topic in your comments. I mean, a lot of US, Canadian banks have quit the Net Zero Banking Alliance. Lots of media coverage about European banks coming under pressure, all sorts of pressure to also rethink their membership, not just of the NZBA, but other generally of net zero alliances. I mean, what do you make of all of this?
Maybe not so surprising given the current climate, and I guess the backlash against, ESG topics. But at the same time, I think from a credit perspective, what's important is the fact that banks are managing climate-related risk. So the fact that they are part of global initiatives or not part of global initiatives doesn't mean that they're not managing these risks. So, that would be the aspect, that we focus on. And we believe that the supervisors are also taking, such a pragmatic approach. The ECB since 2020 has issued guidelines about how banks should manage these risks and as well as handle disclosures. And they certainly have a lot of expectations that, banks follow, but nowhere in there is the expectation that banks join these global initiatives. Now, granted, the fact that they're leaving these initiatives now could be a blow to reputations. And as well, I guess when you are publicly part of an initiative, there can be peer pressure to achieve certain aspects. So I guess we would watch that aspect also, but really it boils down to are banks managing the risk? So.
Yeah, no, for sure, absolutely. Okay, I'm just we're coming up to an hour, and I think we should, for the benefit of our very patient viewers, call it a day in a second. before I do, there is one question which I'm just going to mention, but we're not going to address at this point. There's a question about the impacts of the NBFIs on European bank, particularly private credit. And obviously the European Central Bank has expressed some concerns very publicly about banks' exposures to private credit. But we're going to actually, hope you don't mind, we're going to pass on that one for now. I know we are developing some thoughts around that. And so to our questioner, thanks for the question, and we will reach back out to you at the point at which we have anything to say specifically on private credit. So hopefully that wasn't too clumsy a steer. Let's close it there. I wanted to give you all the opportunity to download those documents I mentioned at the beginning, including a sneak preview of our Banking Outlook document. So if you go to apps at the bottom of the screen on the right hand side and click on that, just above you'll see handouts pop up. Click on handouts, and there are two PDFs that you can download. The first one is, let's say, the European, the first one is a climate risk study, which goes into the methodology behind the study that we conducted and goes into the outcomes of the modeling that we conducted very clearly with, as Paulie mentioned, a tripling of credit losses in the hothouse and adverse NGFS scenario. And the second one is, actually may have got the way around. But anyway, the other one is about the Banking Outlook, which covers some of the ground that was in the presentation today, but the team have actually added a lot of text narrative to each of the charts. So it kind of covers what everyone's been kind of saying on the session today. So do download those in the remaining few seconds. Just remains for me to thank Pauline, Alessandro and Carola very much for your great comments. I think you covered a lot of ground there with style, as ever. So thank you very much, and thank you to our viewers for watching and staying till the bitter end. Hope you found that useful. If you have any further questions, please feel free to reach out to us individually, and we'll be more than happy to circle back to you on a one-on-one basis. So with that, we'll say goodbye, and we wish you a very successful rest of the afternoon.